Hi, everybody. Welcome to the offices of Attract Capital. I'm here with Mr. David Barnett, CEO and founder of Attract Capital.
Hi, everybody. Good afternoon.
And I'm Sonia Bellum. And we're here to talk about the art of optimizing your lending capacity. And before we start, we will not have any camera operational difficulties because we have a brand new tripod. So we're stable and we're ready to go.
Sonia fixed the technical issue from the last webinar. She's wonderfully resourceful.
Yes, many of you commented, in fact, on Dave's unflappable recovery from the camera crashing to the floor and continuing on in stride with his webinar.
I attribute it to my yoga training and my ability to do handstands.
Oh, really?
Yes.
Handstands, so that helps you with your balance and
Absolutely.
ability
I
to
was
focus.
able to catch it just in the nick of time.
Yeah, good. There's a tip for everybody. Try practicing your yoga handstands to keep calm in crisis situations. So today we're talking about the art of optimizing your lending capacity because everybody wants a bigger loan.
That's sort of something that everybody talks about, Sonia. Bigger is better in the lending capacity, but it's not just because bigger is always better. There's reasons for bigger being better, and a few of them are you want to make sure that when you're buying another company that you have enough cash on hand because it may take longer to do the things you want to do with the company. You need to have some surplus cash because if it takes you longer, you want to be able to do those things. So it gives you an element of safety. You also need to have more cash because of liquidity. You want to make sure that if you get into a jam, you have enough cash on your balance sheet to get out of the jam. So it's sort of an insurance policy. And the third reason you would want a bigger loan, in my view, is because what good is it to buy a company unless you have the cash to grow the company and to invest in the company? So it kind of doesn't make sense to spend $10 million buying a business unless you have extra capital available to you to help you grow the business and to change the business the way you want it. So it kind of makes sense. So bigger is better because of these reasons. And I always advise the Attract Capital clients that they want to go for a bigger loan because it's really not the cost of the money or the price of the money that affects the success of the deal. It's do you have enough money? It's not the price of the money, it's do you have the availability of the money? And that's what I advise my clients, and we've done it very successfully because they take to heart this whole notion of a liquidity insurance policy.
Yeah, it's being prepared for whatever comes at you, I suppose.
Exactly. It's like saving money for a rainy day because you never really know in a company. You can lose a customer or you might have some sort of disruption. Your facility might get hit by lightning or something, an active nature. And you really need to be nimble and have the capital to be able to maneuver through those tough times.
Right. If you're going to go through the process of buying a car, it might as well have a good set of tires on it so you can get to where you need to go.
You got to go vroom in the car.
That's right.
You need the tires.
That's right. You need to grow. And if you're going to grow, then you need tires. Exactly.
Absolutely.
So how do you optimize lending capacity, Dave, for your clients?
It sounds mysterious, Sonia. Optimizing your lending capacity. I'm going to
crystal ball. We need a crystal ball, yes.
I'm going to make it really simple. There's three things you have to do. You have to know the variables that the lenders use. Okay. You have to focus on a cash flow lender, not an asset-based lender, but a cash flow lenders. Cash flow lenders make loans to you based on your EBITDA and a multiple that is somewhat of a subjective number that they come up with. So it's only cash flow lenders. You have to know what the variables are, and you have to appreciate that the lending capacity is not black and white. There's many shades of gray when you get into these variables when you're trying to optimize your lending capacity. So it's really doing your homework and knowing what the lenders are looking for, Sonia.
And so can you just focus in again on those two variables?
Sure. So one is the multiple, or some people call it a multiplier, and the other is the EBITDA. Okay, so the EBITDA is your earnings before interest, taxes, depreciation, and amortization. Okay, but
it's a mouthful.
A lot of people call it EBITDA. Some people call it EBIT, and they leave the depreciation and the amortization in there. But it's the world in finance operates. It's the lingua franca of the corporate finance world. It's called EBITDA, and I've been studying EBITDA for the last probably 35 years, and I became kind of fascinated with it when I was a student in college, and kind of have continued to be curious about it ever since. But what you do is you want to so the debt capacity is your multiple times your EBITDA.
Okay.
So the trick is, how do you increase your multiple and how do you increase your EBITDA? And that's where the shades of gray come in. And those are the things you want to focus on, because if you can increase the multiple and if you increase the EBITDA, when you multiply those two numbers, you automatically get a bigger product. You get a bigger number, a bigger loan at the end.
Okay. So what are the things that you do to get through those shades of gray that you said?
Okay, so let's focus on the multiple.
Yes.
So when you're looking at a multiple and you're trying to expand the multiple, you really want to ground your explanation of what happened to the business historically. You want to look at the EBITDA and analyze why it went up, why it went down. Did the gross margins go up? Did the operating expenses go up? Did the revenue go down? Did you lose a customer? Did you stop selling a product line? Did you lose a few key salespeople? We call it grounding your EBITDA.
Okay.
Very important to explain what happened historically and ground the lender in what happened to the EBITDA, because it's going to build.
I have a question.
Yeah.
How far back do you need to go?
I'd say when you're grounding your EBITDA preliminarily, you want to go back 3 years.
Okay.
And you really want to analyze the most recent 3 years that prior to the period that you're the most current period.
Okay.
But you also want to, so you want to ground your EBITDA. You also want to explore this customer, the stickiness and the level of repeat revenue you get from your customers. Lenders like knowing that customers come back every year and that there's sort of a repeatability to the revenue based on the same customers. You really want to focus on your customer consistency when you're explaining the business, when you're trying to build the case for a higher multiple.
Okay. So what are some other aspects that you do when you're building trust with your lender?
You want to explain if you have contractual revenue. That means that, by virtue of having a contract, that revenue is going to come in every year. And you also want to talk about how important your products are, such that if you hit a recession, there's still going to be stable demand for those products. So we had the financial crisis in 08 and 09. So a lot of lenders are going to say, well, how did your business hold up? How did the revenue line hold up during that stressful period? So you want to do all those things. And if you can do that, and if you can show that you've got good revenue visibility and you've got sticky customers, and you can explain with some logic what happened historically, you are then building your trust. The lender is more likely to trust your judgment.
Right.
And it's very important for the lender to trust your judgment, because when the lender trusts your judgment, they will rely on your analysis. If they trust your judgment, they will rely on your analysis.
So you want to adopt their language. You want to think, act, speak as if you yourself were a lender.
Absolutely, Sonia.
Yes.
That is so important. What you really want to do is when you're breaking it down this way, customer stickiness, product demand, revenue visibility, you are adopting the framework that a lender adopts when they're looking to qualify and they're analyzing the business that they're going to make the loan to.
Right.
When you use this same methodology, they see you thinking the way they do. That makes them more comfortable. They're more likely to trust your judgment. And when they trust your judgment, they rely more upon your analysis. And one of the keys to doing this, it kind of weaves through all these things we're talking about, is qualitative analysis and qualitative explanation. Qualitative explanation means being able to explain what happened, to be able to get behind the numbers. You just don't go to a lender and say, well, I want to, typically you would give me a 2 times multiple, but I want a 3 times multiple. You need to give a lot of detailed explanations as to why that is. And when you do all that qualitative explanation, it leads to a quantitative increase. So the qualitative explanation leads to a quantitative increase in your multiple. So it's getting behind the numbers and applying somewhat of a forensic analysis approach to it, sort of a Socratic method. Well, what happened there? Well, why did that happen? Who, what, where, why, when? You get into the details, you explain it qualitatively, and you get that lift in the multiple, that quantitative increase, which is really what this is all about. And that's what makes this more of an art. It's not just a science, but it's the weaving together of the language, it's the weaving together of the historical analysis, and it's weaving together credibility you build as a communicator of this information to the lender. If you have standing and if you have credibility, they're going to rely and they're going to give you the benefit of the doubt more often than not.
What about the future, though, Dave? Like, say you have a patent pending or some kind of great idea for this business to help it grow and become a massive success. Does that come into how a lender thinks and
Absolutely, absolutely. That's a great question, Sonia. Particularly because cash flow lenders are lenders that are not only making a loan based on where you are now, but where you're going. So if you've got a patent, if you've got a new product, if you've got a big contract win, you want to talk about that with the lender, because that will give the lender a better ability to say, well, the numbers are going to be much bigger into the future, so we can give them a bigger multiple. So I've focused more on the historical proving out of the numbers and showing that you're a master of all the historical fluctuations. But the future is very important, Sonia. That is an absolutely perfect point to make, because with cash flow lending, they do fund you based upon your growth potential, and that's another way that you can move up the multiple. So just to put a finer point on this, so if you have a company that's doing $2 million in EBITDA, okay, and let's say originally somebody would give you $3 million in EBITDA, and someone's going to give you a 2 times multiple, okay, that's a $6 million loan, 2 times 3. If you can get that lender up to a 3 times multiple, you take 3 multiple times 3 million of EBITDA, you get to $9 million. That's $3 million more than the original loan.
Right.
That's huge.
Yeah.
So pushing the multiple and being able to make the arguments for why it can be sustained at a higher level is really important to getting the loan that'll make a difference to your company.
Right. No, that makes sense. So let's talk about pro forma cost adjustment, which is a mouthful. I'm getting a vocabulary lesson today.
Okay, so the multiple is the first variable. The second variable is EBITDA. Okay, and when you go to a cash flow lender operates on a pro forma EBITDA, not just a historical EBITDA, but a pro forma EBITDA. So pro forma EBITDA means that you're making adjustments to the historical actual EBITDA. So to make it really simple, if the historical actual EBITDA is $2 and you have $1 of pro forma adjustments, you add the $1 in pro forma adjustments to the $2 million and you get to 3. Okay, so you're basically, pro forma means that there's either a change that occurred recently or a change that will occur when you buy the business that will result in cost savings. And those cost savings get added back to the current profit, so that you're able to say, going forward, we might have only made $2 historically, but because we've got $1 of cost savings, we're going to make $3 on a future basis. Does that make sense?
It does. So it's any type of internal adjustment. It could be restructuring. It could be changing where you're manufacturing the product. However you're doing it is pro forma. Anything.
Beautifully said, Sonia. It's absolutely right. It's got to be something that is very easy to explain. You've got to be. It's got to be crystal clear, and it's got to be defensible. So you've got to have it. So it can be you're manufacturing it somewhere else. You're bringing more technology into the process. You're able to negotiate lower prices from one of your suppliers. But basically, it's where you had a cost of X and now you have a cost of Y, and you're capturing that difference.
Okay.
But it really comes down to getting the lender to buy into it. So a lot of times we see what I'll call fake ad backs, and a fake ad back is, you usually see this when somebody's trying to sell a business, okay, not necessarily financing the acquisition of a business, but somebody owns a business, they're trying to sell it, and they basically go to the buyer and they say, listen, we have 100 people here, we don't need 20 of them, and we have 3 plants and we don't need 2 of them. So there's a lot of fake ad backs, and there's a lot of people that propose hard to believe cost adjustments because they want to get a higher EBITDA, and it's just not something that smart lenders are going to buy into, and it'll also hurt your credibility with the lender if you try to advance too many pro forma adjustments, and if you try to get overly creative with it. But nonetheless, it's a very good way to try to increase your loan size, because as we talked about, you have the multiple. If you can take the multiple up, then you have the EBITDA, you take the EBITDA up. It has sort of a compounded effect on those two numbers.
So again, Is a fake add back a pro forma cost adjustment that is not 100% certain, or that it's kind of just frosting on the cake and they're fluffing the pro forma cost adjustments out? Are they fake? Are they real? Are they what is it exactly? The fake add back.
So a fake add back would be.
Can you give me an example?
Sure. So we had a client that tried to say that they had an underperforming salesperson, and they got rid of that underperforming salesperson, and that they didn't need to run the business with that position filled on a go-forward basis. Now, even if they're underperforming, that salesperson was bringing in some business. So it's impossible to look at the business if that person wasn't there, because there was some contribution. So it's where quantifying the contribution of that expense becomes murky, which is to say that you just can't get rid of somebody who's bringing in business and expect the revenue to continue to come in. And there's a lot of things too. Like sometimes you get people that say, well, there was an act of God, there was a weather effect. Like we had clients up in Buffalo, right, which is there's a lot of snow up there. You get like freakish snowfalls. We had a client that said, well, my business was closed down for 3 days in January because of extreme snowfall. And we tried to advance that on behalf of our client, and the lender said, no, snow is a natural occurrence up in Buffalo. You need to build your numbers around the fact that the weather might always have some snow in the month of January. So in a way, it was not an add back that was bought into. But you really need to, with these add backs, you really need to dive deeply into them. You need to question them, and you need to really test your assumptions and make sure that it will hold up under sort of a withering critique on the part of the lender. Because the lender, if you're going to go to a lender and say, I've got $2 million of EBITDA and there's $1 million in add back, they really need to be sure of that, because they're going to base the loan, your ability to repay the loan, on $3 million. If $1 million of add backs, if half of that is fake, then the lender, then your debt service and your ability to pay the loan is going to be much tighter.
Okay, so we were talking about fake add backs. What's a real add back then? Then it's something that's actually bona fide that you can prove. Correct.
So if you have two companies that are coming together, and you have some administrative positions at the one company, let's say you have two CFOs, and on the go-forward basis you only need one CFO, or let's say you have two heads of HR, and on a go-forward basis you only need one HR, or something where you might have two ERP systems, like you might have PeopleSoft and somebody else might have Salesforce, and so you're going to merge the systems and you're going to get rid of one of the technology systems. Those are costs that go away and are avoidable going forward. And as of a certain date, you can say, as of this date, we're not going to have that cost anymore. And it could also be, you buy a company and you don't need a building or an office that they had, so you just don't pay the lease anymore. So it's where there's a permanent change in the cost structure that's demonstrable, that's real, and where you can pinpoint the date at which that cost is going to go away.
Okay, so you talked a little bit about defensibility. Can you explain that one more time, the defensibility of the add back to the audience?
So it's very similar to grounding your EBITDA. When you ground your EBITDA, you're showing a mastery over the historical EBITDA and what any variations were on the historical EBITDA. With the defensibility, it's the same thing. You have to provide detailed information. You have to provide invoices from vendors. You have to provide utilization charts. You have to provide very solid operational and third-party source documents that will get somebody comfortable that your cost is going to go down. So it's really documenting and vetting that lower cost on a go-forward basis. That's what defensibility means. It's not just saying, well, we think it can go down 10%. We think it can go down 5%. It's sort of like, show me the data, show me the detail. And if you can do that, then when the lender does their due diligence and they send their accountant in to look at the numbers, the accountant will get very comfortable because they'll see independent source documents. So it's defensible.
Well, that makes a lot of sense. So let's round up the whole thing for everybody then, Dave, if you don't mind.
Okay, so basically what we're talking about is when you optimize your lending capacity, you're trying to get the bigger loan. You need the bigger loan because you want the liquidity cushion. You want to make sure you have money in order to do all the great things to the company that you have on your game plan. If you go from, I'm going to use an example here. if you have 2 million of EBITDA and you're at a 2 times multiple, that's 4 million. If you take it to 3 million of EBITDA at a 3 times multiple, that's 9 million.
Right.
Okay. The difference between 4 million and 9 million is pretty big. That is often the difference, Sonia, between getting a deal done and not getting a deal done. So understanding how you can influence and ultimately get the lender comfortable with that higher multiple, and getting the lender comfortable with higher pro forma EBITDA is absolutely essential to getting the money you need to grow the company you want and to be able to be successful with acquisitions. Okay,
well, thank you very, very much, Dave. I certainly learned a lot today. And if anybody has any further questions, they can email Dave anytime at dbarnett@attractcapital.com. You can also message us here on Facebook. You can also find David on LinkedIn, and you can message him on LinkedIn as well. And we will be back with another webinar in 3 weeks, Dave?
I think in 3 weeks, in early July.
Yeah, okay, great. So thank you so much, everybody. Thanks for joining us.
Thanks, everybody.
We'll talk to you soon.
Take care.